Hello options traders, welcome everyone. I wanted to do a little bit of a follow-on video to the last one that I posted entitled, How Can the Dow and S&P 500 Have Such Performance Differences? And a lot of new traders wonder, well, if these two indexes are supposed to track the overall broad market, how can they, on some days, have such dramatic differences? One is up a lot, one's down, or vice versa. Sometimes they're up and down about the same. And the answer had to do with the way that they're calculated. Well, as a little bit of a follow-on video, let's answer another question. Is the S&P 500 or the SPX getting more tech sensitive? If you've been following this index for a while, you'll probably realize that when we see these big earnings announcements, whether good or bad, that the S&P seems to be more sensitive to the changes in these tech stocks. So is that really an illusion, or what's going on here? Is the S&P 500 really getting more tech sensitive? Well, let's take a look. If you recall from that video, I said there are two major types of indexes. There's one that's called a price-weighted, such as the Dow Jones, and then there are also capitalization-weighted, which is pretty much the rest of them. There are others. There's hybrids and things like that. There's also an equally weighted index, which I'll talk about at the end of this video. But basically, they fall into price-weighted and capitalization-weighted. So I talked about the Dow and what a price-weighted index means in that last video. But as a refresher, let's talk about the S&P 500. The index, or the ticker again, is the SPX, and it was founded by Standard & Poor's in 1860. And first person who found out was Henry Varnum Poor. That's where the name Poor comes in that name. And then in 1941, it merged with Standard Statistics. And in 1923, had really just a handful of stocks. 1926 had 90 stocks. And then in 1957, it expanded to 500 stocks, which is where we are today. Technically, we have 505, and that's because there are 5 different companies there that have 2 different classes of shares, such as A and B shares or A and C, such as with Google. But we still call it the S&P 500. And it is still the most widely used measure of stock price levels. But it is a capitalization-weighted index. And with any index, there are pros and cons. So let's go over to the Excel spreadsheet and take a look at what it means to have a capitalization-weighted index. This is the same spreadsheet that I showed in the last video, and I'm not going to show all 500 stocks. It's just not necessary to make the point. But here are the top 6. Got 3M up here, traded at 203.16 when I was shooting that video, Abbott Labs 72.86, and so on. We also need to find the number of shares outstanding for a capitalization-weighted index. Because what we're going to do, we're going to find the total market cap, or the total market capitalization, which is very simply the share price, in this case 203.16 for 3M, times the number of shares outstanding, over 582 million. And that gives us this $118.2 billion figure here, which again is the theoretical value of the company. That's what it would cost to buy this company. So if we do that for each company, we do it for Abbott Labs, take the price times the shares outstanding, what's the total market cap? And we go through all 500 stocks. We'd find out that today we've got about $19 trillion worth of market cap. So what we do then is we go through each of these rows, take this 118 billion figure divided by 19 trillion, and we get about 0.62%. So the weight in the S&P 500 for 3M is about 0.62%, so a little over 0.5%. But the point is that these weights over here will change as the stock price changes. Now remember, with the Dow, because it's price-weighted, the stock with the highest price has the most influence. But now it's going to become the one with the highest market cap. So watch what happens if 3M hypothetically goes from 203, let's make it 400, make it $400 here, and you can see its weight now goes to 1.22%. So if the price of the stock, or the price of a sector, happens to be going up, shares outstanding stays reasonably constant, the weights are going to change. And the S&P 500 does not rebalance. It's just a basket of stocks. Now, it will kind of, you don't really call it rebalancing, but it will adjust them if they're going to maybe kick some stocks out that don't really reflect current market conditions and bring in some new ones, very much like the Dow does for the same reasons. But they're not going to change the weightings. But the market price changing will adjust those weightings automatically. So yes, what happens if the tech companies, let's say, start to go into a rally and everybody's following that sector, the S&P becomes more tech weighted. So for example, this is a spreadsheet right here of the S&P 500 just looking at the technology weights. And it goes all the way back to 1979. So if you look right down here, back in 79, the technology accounted for about 10% of the index. But look what happened as we started getting towards the tech wreck of 2000. Look at this right at the peak. Just about 32.5%, 33%. The S&P now was being accounted for by technology. So it became very sensitive, at least compared back to, let's say, 94 or 1990, with the weighting in the technology. Then, of course, after the crash down here in 2001, it was back down to under 15%. But look what's happened now with the rally in all the tech stocks, especially recently, since 2012, back up to about 26%. So if you look from 1979, we're really at one of two highest levels we've ever been in terms of the S&P being weighted towards technology. Now this spreadsheet is updated quarterly, so you can see kind of the big pullback we've had over here. So our current weight is probably more about 22%. But the point that you have to understand as traders or investors is that, especially if you're invested in just the S&P 500 index, that you will become more weighted to whatever the hot sectors are. So when technology takes off, you have to understand your portfolio is automatically getting weighted heavier in that industry, whether you want it to or not. And so this is where you can take some hedging transactions to counteract that risk. So to counter these effects, some traders like to use an equally weighted index, usually abbreviated EWI, and almost all of your major indexes have these. So for the S&P 500, there's a company called Guggenheim that creates the S&P 500 Equal Weight Index, and it trades under the ticker RSP. And with these equal weight indexes, obviously each stock carries equal weight. That's what the name means. So for the S&P 500, assuming there's exactly 500 stocks, each would have 0.2% of the weight. We're just going to take 100% divided by 500 stocks. And that's the way that the portfolio would be initially constructed. And then it gets rebalanced each quarter. So as these stocks rise or fall, the portfolio will then rebalance them back into these weights. They don't let them kind of run out of control. NASDAQ 100 has one, trades under the ticker NDXE, the E for equal weight. And there, each stock carries 1%. So 100% divided by 100 gives you 1% for each stock. And again, all of these are rebalanced each quarter. And the idea is that you're going to automatically buy low and sell high. Because the stocks that take off and are now creating the higher weights have to get sold off to bring them back to their original weighting. And that means you're selling off the stocks that have risen in value. And then you're going to have to buy the stocks that have fallen below their initial weights. And the only way that happens is because the price has fallen. So it forces you to buy low, sell high. That's one of the advantages of an equal weight index. However, it doesn't come for free. Higher turnover means higher fund costs. These funds get in there, again, usually quarterly. Some do it semi-annually and a handful do it annually, but still they have to go in there and rebalance these funds, and it becomes very expensive. These funds are carrying a lot of stocks and they have to go in there and constantly buy and sell. So that can actually cause the fund to underperform. So let's go over to the E-Trade platform and see how that can happen. So here's the S&P 500. I've got the spiders, SPY. And in E-Trade, I can click on this little link down here that says compare, and I can type in a different symbol. Now, RSP happens to be the equally weighted index, or at least one of them, for the S&P 500. So I've actually got it in the list right here. So we're now going to compare the S&P 500, the standard index, to the equally weighted. So the one here in candlesticks is the regular S&P 500, or the SPY, and this green line down here is the RSP, or the equally weighted. So you can see in a lot of the periods here, they're almost identical. But once technology starts to run, you can see that the S&P 500 starts to outperform. We're looking at these compared in percentage terms over here on the right. So these candles sit higher than this green line down here. So the S&P 500 fund, the standard one, the SPY, is actually outperforming the equally weighted one. But that won't always be true. So just understand that it is not an illusion if you think that the S&P 500 has become more tech sensitive. It is, and it all has to do with the way that it's calculated. It is a capitalization weighted index. So of course, whether using the standard index or the equally weighted index, it helps to understand where you are and how to hedge those risks. If you'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and strategy lab at optionsatoz.com. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.